In my business, I get asked questions like these all the time. When is the right time to buy a house? Should I wait for interest rates to drop? And lately, are tariffs going to crash the market? If you're under 40 years old, you might be wondering if there's ever going to be a good time to buy. I know people who have straight up abandoned the idea that they'll ever own a house. And honestly, I get it. The market is confusing right now. There's a lot of noise, a lot of opinions, and a lot of uncertainty. So today, I'm gonna break down whether I think 2025 is a smart time to buy a house or if you're better off renting and waiting it out. My name is Austin Zaback, and I've been in the real estate game for over a decade. I've built multiple real estate companies that have sold thousands of homes. And most importantly, I've worked through all types of market conditions. So if anybody can give a clear perspective on this, it is me. So let's just go ahead and dive into the video. First things first, my opinion won't mean much to you if you don't understand the problem, and that is that there are specific reasons why people are hesitant to buy a house in 2025 compared to maybe 1 year ago, 2, 5, or even 10 years ago. For home buyers and sellers, there are always multiple factors at play. Combined, these factors all create an environment that we tend to refer as the housing market. Without knowing what these factors are and what they affect, you can't really understand why people like me are coming to the conclusions that they're coming to. And right now, the primary factors to consider are rising mortgage rates, high home prices, the affordability crisis, and the overall economy. And we'll talk about mortgage rates in more detail in just a minute. But for now, you need to know that they've been pretty unpredictable lately. They surged past 7% in 2022 and 2023, and while some experts think that there might be a dip later on in the year, there really is no guarantee. This leaves buyers wondering if they should lock in a rate now or wait for a potential drop. Remember that even small changes to mortgage rates can have a huge impact on affordability. So here's an example. Say you're buying a $500,000 home. You put 20% down, that equals $100,000. So your loan amount is $400,000. Now, let's just say, to keep it simple, property taxes and insurance is $150 a month combined. At a 7% interest rate, your monthly mortgage payment, principal and interest, is about $2,661. You add in taxes and insurance, and you're looking at a total monthly payment of $2,811. Now, let's just say that rates drop to 4%. That same $400,000 loan now has a monthly mortgage payment of about $1,910. Add in the same $150 for taxes and insurance, and you're looking at a total of $2,060 per month. And that is a difference of $751 every single month, or over $9,000 a year, just based on the interest rate alone. Same house, same loan, completely different reality. But there's more. Even with higher mortgage rates, home prices haven't dropped much. And this is really due to low inventory, that old supply and demand principle that we learned about way back in high school. Fewer homes on the market mean more competition for buyers, which in turn keeps housing prices elevated. And this really only adds fuel to the fire when it comes to the affordability crisis. You've probably heard your grandpa joke, back in my day, I bought a house for $50 and a handshake. Now, while that's not exactly accurate, the truth is that home prices have grown at a much faster rate than income, making it hard for first-time home buyers to break into the market. In cities where prices are often higher, renting is sometimes the cheaper option, even though the rental market is suffering its own affordability crisis in the recent years. Finally, we have economic uncertainty. It doesn't matter who you voted for. The basic overarching principle is that the markets like stability. And right now, there are ongoing discussions about a possible recession, which is making people doubt their job stability. And we're also seeing some sticky inflation, which continues to impact household budgets and Federal Reserve policies. Now, I should point out that experts are divided on what this might actually mean. Some buyers have major FOMO. They think that the housing market might crash, so they don't want to buy now and miss out on the chance to save thousands of dollars. And others think that the supply shortage is enough to keep prices up regardless of any economic downturn. The point of it is, when the economy feels unstable, fewer people want to take on long-term debt. And you don't get much more long-term than a 30-year mortgage. Now let's talk about one of the reasons so many people under 40 are agonizing over the rent or buy question. Homeownership rates always vary across different age groups, but right now, younger buyers are struggling the most. In the last quarter of 2024, homeownership for those under 35 years old dropped to 36.3%, the lowest number since 2019. Meanwhile, those aged 45 to 54 saw an increase in homeownership to 71%. The same went for 55 to 64-year-olds, who now enjoy a 76% homeownership rate. And as you probably guessed, the 65 and up demographic is the most stable at 79.5%. And in a lot of cases, these folks have long since paid off their mortgages, meaning that they don't have any real incentive to sell. And as long as they're healthy enough to live in a home, they're probably not going to go anywhere. And this reveals a trend that is putting massive pressure on both the housing market and the people involved in it. Older generations are holding onto their homes, while younger buyers are having a harder time breaking into the market. Meanwhile, there aren't any big signs that supply is going to free up anytime soon. So given these facts, it shouldn't surprise us that young adults today are buying homes at a much lower rate compared to previous generations. For instance, only 33% of today's 27-year-olds own homes, while 40% of baby boomers owned homes at the same age. While it's true that younger generations tend to be less focused on stuff, there's more to this than just people purposefully delaying homeownership until later in life. All right, so let's circle back to mortgage rates, and we sort of have to, because these are among the biggest drivers when it comes to the housing market. Most people think 6 to 7% mortgage rates are terrible, and compared to rock bottom 2 to 3% we saw during the pandemic, it's pretty understandable. But here's where I encourage you to look at the bigger picture. If you do, you'll see that today's rates aren't as unusual that some people claim. Over the last 50 years, mortgage rates have been all over the place. In the 1980s, they peaked at a staggering 18.63%. By the 1990s, they stabilized at around 6.5% before returning to fluctuation in the 2000s. And if you're old enough to remember that major crash from 2008, that was when we started seeing mortgage rates hit 3.5%. And the same thing happened after the pandemic when they hit an all-time low of 2.65%. And today we're around 7%. And this is mostly due to two things: inflation pressures and the Federal Reserve policies. If you're unfamiliar with this, the short version is that when inflation is high, lenders have to increase their rates to remain profitable. And this is why mortgage rates tend to rise during periods of high inflation and fall when inflation is low or declining. The Federal Reserve, meanwhile, typically raises interest rates to slow down economic activity. Higher borrowing costs discourage spending and investments, which can help cool inflation. However, this also means mortgage rates rise, making home loans more expensive. So what does all of this mean for buyers in 2025? Well, for one, you need to understand that when you look at the history of mortgage rates, we're actually not far off from the historical average at all. Rates only seem sky high compared to what we saw after the crisis in 2008 and 2020. And more importantly, you need to remember that mortgage rates don't stay the same forever. So if you lock in a higher rate today, you always have the option to refinance later if rates drop. And that is why many buyers are following the marry the house and date the rate strategy, if you've ever heard of it. Rather than lock in the rate, you lock in the home and plan to refinance when the conditions improve. Speaking of which, the final factor we're going to look at is home sales. Now, if you've ever heard of somebody referred to a buyer or seller's market, this is what they're talking about. So where are we at right now? Well, reports indicate that U.S. home sales took a big hit in 2023, dropping to just 4 million transactions. And that is the lowest that they've been since 1995, the year that I was born. It was also a big decline from the 6.12 million homes sold in 2021 when the market was red hot and mortgage rates were at all-time lows. Again, the pandemic, I'm sure we all remember. But these slow sales continued in 2024, showing no real signs of recovery until early February of 2025. And that month, existing home sales rose by 4.2% compared to January, but they were still 1.2% lower than February of 2024. But while this is still a win, it didn't occur in a vacuum. That same month, the median home price increased by 3.8% to $398,400, marking the 20th consecutive month of price growth. And this brings us to where we are right now. Reduced inventory and sluggish sales are potential drivers for buyers. Meanwhile, the fact that interest rates and prices are above most people's preferred threshold is hindering those purchases. For me, one of the most interesting facts I came across relates to home equity. According to Bankrate, about 48.3% of mortgaged homes are equity rich, meaning the owner has at least 50% equity in their home. This suggests that most homeowners aren't at risk of foreclosure, which is one reason we're unlikely to see a housing crash like we did in 2008. So while affordability remains a challenge, there are signs that the market is stabilizing, with cautious optimism about a gradual recovery in the second half of 2025. So taking all of this information, and I do mean all of it, into account, here's what I can tell you. First, the housing market isn't in nearly as bad of shape as the news might be letting on. However, if you judge it based on what we saw in 2009 or 2021, or when your grandfather bought his first home, the market will always look bleak. I will say that buying a home in 2025 isn't a one-size-fits-all decision. Yes, mortgage rates are higher than they were a few years ago, but historically, they're not outrageous. And while prices are still high, waiting for a perfect time to buy is a little bit risky if you ask me, because the perfect time may never come. If you find a house you love and you can afford the monthly payment, it's not a bad time to buy, especially since you can always refinance later if the interest rates drop. On the other hand, if affordability is a real concern, waiting might not be a bad move either. At the end of the day, the best time to buy a home is when it makes sense for you and your family financially. Whether you buy in 2025 or wait it out, the most important thing is having a strategy that aligns with your long-term goals. So look, I'm building a house right now and I plan to close on it in June of 2025. So I myself am doing exactly what I talked about a little while ago, which is marry the house and date the rate. And I fully intend on refinancing my house within the next 12 to 18 months and getting my payment a little bit cheaper. Thank you so much for staying to the end of the video. Again, my name is Austin Zaback. I've built multiple real estate companies and sold thousands of homes over the last decade. I would greatly appreciate if you would subscribe to my channel and maybe even go check out some of my other content. And I look forward to seeing you in a future video.